What if the stocks everyone hates right now are the ones that could make you the most money? In the next few minutes, I'm going to show you four market giants that are being punished by Wall Street and why that panic is creating a massive buying opportunity for us this November. These aren't random companies. We're talking about household names like Pepsi. They're all trading near their annual lows, but a special force is about to unlock their true value. Stay with me to find out what that is. The secret ingredient in all these plays is something called an activist investor. An activist investor is a person or group that buys a large stake in a company to influence how it's run, often forcing changes to increase the stock price. They shake things up for the better. Let's start with our first hated stock, Kenvue, ticker KBY. This is the new company that was spun off from Johnson & Johnson. It owns legendary brands like Tylenol, Neutrogena, and Aveeno. So why does Wall Street hate it? Fear. There's negative news about a potential link between Tylenol and autism, and the market is panicking. But here's the reality. Tylenol is only about 10% of Kenvue's business. The company is a cash-generating machine, a truly defensive business. It's trading at a very low price for the quality you're getting. The catalyst? An activist is pushing for changes. The big move could be selling or spinning off its skin health and beauty unit, which includes Neutrogena and Clean and Clear. That division alone could be worth between $6 and $9 billion. The market is pricing the whole company for disaster, but its individual parts are incredibly valuable. This is a perfect example of looking past the headlines. If you want more analysis like this that cuts through the noise, make sure you're subscribed to the channel. Next up, a company everyone knows, Pepsi, ticker PEP. Pepsi is a giant, but Wall Street is bored with it. They see it as a slow-growing company with lower profit margins than its rival, Coca-Cola. But the problem isn't the brands, it's the structure. Pepsi not only makes the drinks, but also bottles and distributes them, which is a low-margin business. The powerful activist fund, Elliott Management, is pressuring them to make a change. The catalyst here is a spin-off. A spin-off is when a company creates a new, independent company from one of its divisions. Elliott wants Pepsi to spin off its bottling business. If they do that, the remaining PepsiCo becomes a much more profitable company overnight. Its stock could then trade at a much higher multiple, just like Coca-Cola. This idea of separating business units is a recurring theme today, and later I'll tell you about a company where this strategy could make it an attractive takeover target. Our third hated company is TripAdvisor, ticker TRIP. The market sees TripAdvisor as a great brand with messy execution. Its stock is depressed because investors think it's too complex and unprofitable. They are completely missing the point. TripAdvisor is a free cash flow machine. Free cash flow is the cash a company has left after paying for its operations and investments. It's like its real take-home profit. TripAdvisor generated $171 million in cash in the last year, which is incredible for a company of its size. The catalyst is activist investor Starboard Value. They are pushing for two simple things: sell their restaurant reservation platform called Fork and improve the profitability of their tours and activities business, Viator. If they do this, the company becomes simpler and more profitable. That would make the core TripAdvisor brand shine, turning it into a prime target for another company to buy them out at a much higher price. Finally, our fourth hated stock, Constellation Brands, ticker STZ. The market is punishing this company for one major mistake: its failed investment in the cannabis company Canopy Growth. But this is a classic case of throwing the baby out with the bathwater. Constellation Brands is the #1 beer company in the US. Its core business, with brands like Modelo and Corona, is absolutely crushing it with great growth and expanding margins. The cannabis investment was a mistake, but it's a small part of an otherwise fantastic business. And the catalyst? Elliott Management is involved here too. They are forcing the company to get its act together. The plan is to focus on the amazing beer business, sell off non-core assets like their wine division, reduce the cannabis exposure, and use the cash to buy back their own stock. This clear focus could unlock 30 to 50% upside from here. The risk versus the potential reward is fantastic. The market is driven by emotion, but smart investing is driven by logic. These four companies show that when fear is high, opportunity is even higher. The key is the catalyst for change, and in these cases, it's the pressure from activists forcing management to unlock value. Don't just follow the crowd. If this analysis helped you see the market differently, subscribe to Minuto Inversor for more. Now, I want to know what you think. Which of these four stocks do you find most compelling? Let me know in the comments below.